Okay. Pierce, welcome. All right. Welcome, everybody. How are we doing? I'm going to go ahead and get us started here. While Mr. We have a special speaker today, which I'm excited about. So let me click on that. All right, everybody. Hey, welcome to another Mastermind, Deferred Sales Trust Mastermind, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is an amazing way to defer highly appreciated capital gains on the sale of cryptocurrency, businesses, real estate, so you can create and preserve more wealth or help your clients do the same. For those who don't know me, my name is Brett Swarts, and I'm founder of Capital Gains Tax Solutions. And each week I am joined by one of my strategic alliances and financial advisors extraordinaires, Jake Miller. Jake, how are we doing today?
Doing wonderful here in sunny La Quinta, California. Having a great time. Happy to be here, and it's going to be a great conversation. We got a number of wonderful people who've joined us today.
Absolutely. And we do have a special guest speaker, which I want to dive into right now. Make sure David can hear us okay. David can hear us okay.
I can hear you great. Can you hear me?
I can hear you great too. So I'm excited, everybody, to introduce you to one of the DST kind of inner circle advisors for the Deferred Sales Trust. They serve as a kind of an upper, let's say, extra layer of advice or advisory for clients on managing money. So they actually serve financial advisors. And in fact, he is the founder and chief executive officer of Anfield Capital. They're down in Southern California, and he has over 30 years of investment experience. And he's worked with some of the largest and most sophisticated institutional and private investors in investment strategy, portfolio management, and asset allocation. He's a former executive VP at PIMCO. He ran with a guy named Bill Gross for very, very many years. That being said, please welcome to today's special guest, David Young. David, how are we doing?
Doing great. Thank you very much for having me on. Nice
absolutely.
To meet everyone else.
Yeah, absolutely. And for everyone who's getting to know you for the first time, David, would you give them a little bit more about your story and your current focus?
Sure, happy to. I joined the investment management industry, many years ago, 35 years ago it must have been. And it was back in the day working for Smith, Barney, Harris, and Upham, making money the old-fashioned way. So we're really going back there. Saw an opportunity to go to business school, get an MBA, got kind of recruited by PIMCO, worked there for many years. I forget all told how many it was, both here and in the US and in Europe. Had an opportunity after Allianz acquired PIMCO to move to London and Munich and open an office in both cities. It was really a tremendous experience personally and professionally. My entire life I've been a practicing economist, money manager, and decided probably, must be 12, 13 years ago, with a few of my colleagues at PIMCO that we would leave the firm under a very positive set of circumstances, start our own investment management firm, and focus on financial intermediaries. And we were very fortunate 2 or 3 years ago to be put in touch with estate planning team, Bob Binkley, and Brett Swarts and the team, help them understand and develop what we believe is the optimum way to manage the assets, at least the tradable liquid kind, right, that can go inside of a deferred sales trust. And that's been our story. So we're this kind of a bunch of gearhead money managers, and proud of it.
Amazing. I absolutely love it, David. I love that you're part of the team and a part of the kind of the vision, or I like to say the movement of becoming a deferred sales trust believer, right? Every single day we're getting folks that say, oh, it's still too good to be true, or my CPA would have known about it, or my financial advisor would have known about it, or it just seems like, everyone would know about it. And we'll touch on that a little bit later because I know you've kind of told that story before on our podcast and everyone can take a look at that. But I actually want to dive in today and just talk about kind of the market update. In fact, I think you guys recently had a post on your blog on infieldcapital.com, which would be what would cause us to reconsider. And the question is the ever elusive next black swan event, being kind of what's the state of the market right now, and what do you think that potential thing that could derail where we're at. Even these last couple of weeks with interest rates and what we're talking about, can you kind of give us the state of the market? Where do you think we're at, and what potentially could cause maybe a recession as best you can there?
Sure, a lot in there. I'll endeavor to hit the high points and let you and the other participants drill down on anything that's of interest. I would take a step back and say we have to put the current market environment in perspective. 2 steps back in the run up to the great financial crisis. So now we're way back now, right? We're back in the 2006, 7, 8 period. There was too much liquidity in the economy, the U.S. and global economies. Those systems are very big and they have a lot of different places where money can go, but at the end of the day, they are still effectively a closed system, and the money has to go somewhere. Ultimately, it can go into real estate, it can go into cryptocurrency, it can go into stocks, bonds. The list goes on, but it's got to go somewhere, and that process can be orderly. It can help fuel economic growth. It can be disorderly if there are impediments. Almost like the way water might flow down a mountain, right? Melts at the top, and it can turn into a river. It can turn into a big muddy puddle. It can turn into a pond with a waterfall, and all is right with the world. But a lot can happen on the way. So, everything kind of getting back to normal, 2007, 8, 9, 10, 11, 12, 13, 14, fast forward, still too much money in the economy. As an overhang from the great financial crisis, wham, we get COVID. And now all of a sudden we have even more money in, the economy and in the economies. Some of it checks in the mail, some of it lower interest rates, some of it government support and stimulus for different parts of the credit bond market or other markets. And we all kind of live that recent history. So now we have even more money in the economy. And, money is also, it's fuel for growth. It's also, sorry, I should have turned that off. So it's just this process of trying to figure out how do we digest all this excess fuel, if you will, and fuel can, be great, but fuel can also cause, bubbles and mini explosions and other bad things might happen. So where are we right now? I think the Fed was set down a path to raise interest rates, which they are still on. We think that's actually a good thing to try and take some of that excess liquidity out, right? Dampen down some of the very, very strong demand-driven kind of demand pull inflation, right? It's good to a point, but not to an extreme. I think inflation was gaining traction, and we started the year seeing what we called a post-peak everything environment. So what is post-peak everything? Post-peak everything is the best of the post-COVID growth behind us, the best of the post-COVID earnings bounce for corporations behind us, the lowest of interest rates, and therefore the highest of the bond market. They're inversely related, of course. And I could keep adding, right? The peak of earnings gains. I mentioned that the peak of job gains, and we could go through the entire economy, and that post-peak everything would fit. And that doesn't mean the world had to drop off. There doesn't have to be a cliff on the other end of it. It could be a plateau. In the case of inflation, it might remain elevated. It could be just a gradual, coming off of a peak in a more orderly manner, and it didn't have to be disruptive or problematic. And then we get, Ukraine. And so all of a sudden we go into another phase where we have yet another key driver of inflation. And economies are interesting. They can manage one source of inflation, maybe demand pull, another source, maybe some supply chain scarcity, maybe another source, maybe weakened currency because of persistently low interest rates. But as you start to add onto the list of rocks that the economy, inflation rocks that the economy has to carry in its backpack, at some point you reach a tipping phase, and we think we probably reached that tipping phase. Certainly, labor cost was another very important development where it becomes systemic. That inflation gets into the ground of the economy. Once it does that, it's very hard to get it out. We think we're probably there now. The last straw really being recent increases in oil, energy, and some foodstuffs prices. But don't underestimate the very sticky nature of wage and labor-based inflation as well. That tends to be very sticky as well. So that's where we are now. We had the right view of everything. We just didn't see this massive acceleration that came about through Russia's invasion of the Ukraine. What's interesting is if we take a little step back and look at year-to-date asset market performance, people would look at the year-to-date returns and say, oh, stocks are down 4, 5, 6%, bonds are down as much. That's unusual. Cryptocurrency and other assets are down from their highs, and say that's the problem was the Ukraine. But if you look at the data, that does not actually support that. Most of these markets were already weakening in the latter portion of 2021, fourth quarter in particular, probably looking forward, seeing that some of the best news was behind us and rates were likely to go up and inflation was really starting to bite. And actually, since what we mark as being the invasion of the Ukraine, we take that all the way back into more the middle portion of February. I don't think the Russian boot crossed a border until later, but clearly things were changing and the market was starting to look at what was happening there. And so since that time, very oddly, bonds have continued to weaken. Fed's raising interest rates, and inflation is starting to hit there. But other assets have actually firmed and gone up since that time. So maybe that's an indictment on humanity, that markets didn't seem to care a whole lot about this terrible human tragedy unfolding in front of us. We're not here necessarily to take a position on that, but to report and analyze and try and understand. And so I think it's important to know that, though, and also know that investors have been enjoying clearly outsized returns for the last 5-10 years anyway. So, we're 2, 3, 4% on an annualized basis ahead of where you might think we would normally be if you invested in the S&P 500 or if you invested in, other risk assets. So you're still well ahead of the game. And if we shift then to looking forward, we're not too worried about the rising interest rates. It's healthy actually in the end. We're not too worried about the heightened level of inflation. Markets will equilibrate. Things can be adjusted. We're not too worried either about the relatively high level of oil. Oil has been at these levels or higher for extended periods of time. I don't think people probably remember, but in the kind of spring of 2011 through probably the middle portion of 2014, we had oil above $100 a barrel on a very consistent basis, and those were generally good times for economies and markets. Not great times, but they were good times. And so again, economy can manage any one of a number of these things, 2 things, 3 things. You start to get into 4 and 5 things, which is where we fear we're going. You do reach a tipping point. So we are starting to talk about the risk of recession, probably not in 22. There's enough momentum and the underlying economy is sturdy and there's enough fundamental support to get us through the next 6-9 months. But it wouldn't surprise us too much, probably 50-50 probability that in the first half of 2023, we could experience either a material growth slowdown. That's a fancy way of saying economic growth doesn't go negative, but it slows down a lot, and maybe even begin to flirt with this idea of a stall speed. So we'll take from aviation and physics and aerodynamics. Economies, the U.S. economy in particular, you start to grow at rates in the 0.5%, 0.75% annualized real growth rate. That the difference between 0.75% growth rate and zero is virtually nothing. It's one bad quarter. So this idea of an economy being even below 1% growth, it's kind of stall speed. There's not enough forward momentum, not enough lift under the wings of the economy to have it growing enough to be kind of self-propelling, self-sufficient. So we'd be worried about that in the first half of 23, but at least for the balance of the year, we think we can manage through this period.
It's a great overview, and so much there, so many ways that we could take that. But I do want to point out a couple things. The economy has to carry on its back, in its backpack, if you will, a bunch of rocks, and these rocks could be labor costs, it could be supply chains issues, it could be Russia, Ukraine, it could be a number of things, price of oil, and the question is, when is too many rocks too much, and then how quickly does that lead potentially to a recession, right? And so, which leads me to this question: if you're a highly appreciated seller of an asset, whether it be cryptocurrency or a business or a primary home or commercial real estate or public or private stock, you have a huge accumulation of a single asset in a single place. What's the one question you should be asking, David, at this point? And if you're in that shoes, like what do you think they should be asking to find out if something like a deferred sales trust would be a good fit, something like just diversifying, or just the basic fundamentals of investment theory, if you will?
Yeah, and so as economists and money managers, we're not afforded a lot of jokes, and we only really have a few. And then one of them is this traditional, economists always say, on the one hand, the markets are up, but on the other hand, this is an opportunity to maybe, take some losses on some things that have been beaten up recently, and then the king cries out for a one-handed economist. Probably offend somebody with that joke anymore, but anyway, so that's our one joke. I said it, but there is some truth to it. There is another side of this situation, which could be looked at, as an opportunity. Some assets have given back a bit of that, long, multi-year kind of excess or at least higher than expected returns. And so, is that an opportunity to reposition? Is it an opportunity to, trim, which is always a good risk management philosophy or process? Trim some holdings, be they individual stocks, be they, cryptocurrency, be they real estate, whatever the case might be, maybe and reposition and move away from what can be, a concentrated set of investment holdings. Concentration is not good from a risk perspective, because if something goes wrong with one of your concentrated holdings, well, you're really going to feel that. So, and then the question becomes, okay, great, that could make some sense, but how do I do it? How do I do it tax efficiently? I like the idea of generating, some long-term gains. I like the idea of matching off some shorter-term losses. There's some math in there. See your financial advisor. We are not tax experts. We don't know your situation, but there is something to be said there. The problem is only so far that you can use those traditional tools of, tax efficient is a very strong word. We would call it tax aware management and repositioning of assets and portfolios. It's a softer form of efficient, which I believe is sometimes overdone. We see investors and even advisors in the pursuit of minimizing taxable implications, actually waiting for assets to come down further. I've heard people say, "Oh, I don't want to sell now. I'll pay too much in taxes. I'm going to wait for prices to come back down." Wow. Like, wow. Okay. But there is another way. And the other way is to not, is to step outside of these limits of what can be done in a traditional tax aware and tax management process and look to other vehicles. And the Deferred Sales Trust is a vehicle that can allow a number of different options as it relates to tax management. It's not tax avoidance. It's nothing, risky. It's not in and of itself, a tax dodge. Get those ideas out of your head. Nobody on this call would be involved in that. Brett would not be involved. I would not be involved. It is a completely legitimate and increasingly commonly used structure that allows you to decide when you will pay taxes on the sale of appreciated assets. And I'll stop there, Brett, and turn it back over to you.
Yeah, no, I think that's so well said, and it's that is the biggest question, right? It seems too good to be true, and it seems like my financial advisor or my tax professional, or even the idea that the person who helped you to get from that first 0 to 1 million, or that 1 million to 5, or that 5 to 10 million, the concept of it doesn't necessarily mean they're the same group of folks to help you get from that next level of service, that next level of an idea. Not any one of us has the all-encompassing crystal ball with all the ideas. We've got to bring in experts, and there's people that have been doing this. And so what I love about the DST attorneys who created this 26 years ago, like, this is their creation. They built this, and it's protected, it's proprietary. But on a podcast episode, you mentioned that, like, it's the two-edged coin of something, right? Where you want to protect it and you want to provide it for folks, but you also don't want it to be abused, right? Or brought out to folks that aren't going to use it properly. So can you talk a little bit about that concept? And then the second concept of, you manage some of the biggest wealth in the for folks in the world, and different aspects, very, very wealthy folks, right? Over the years with PIMCO and such, the aspect of that first 1 to 10 million, or that first person who's in even a tech entrepreneur, goes from 1 to 100 million, and you're helping on another level, if that makes sense, and still also trying to maintain working as a team, right? Working with everybody to service the client.
So yeah, there's a couple different ways I could go with that. Let me try this, and you redirect if I go off,
sure,
as I have been known to do, into the weeds. Well, first of all, the idea of just talking about the vehicle, right? The trust, the instrument. It's not new in concept, certainly. 1031 exchanges are widely used and widely accepted. There's a range of different, deferred or contingent sales sorts of mechanisms that are tried and true and clearly part of the code, and it's okay. I think the trouble comes in the actual structuring. You mentioned lawyers and tax professionals and how it's done. Like so many things in the world and in business and in life, it's how you go about doing it that can matter a great deal. And there's been a tremendous amount of time and effort spent, and a lot of deferred sales trusts done in this format. And so I would encourage anybody who is thinking about going down this path. There are different structures out there. You should do your research, certainly seek guidance from tax and other legal professionals who would guide you in this regard. But I think the thing that makes, in our opinion, the DST so powerful is that it doesn't try and do too much in a strange way. Sometimes it's knowing the lane, knowing the boundaries, staying in the boundaries. You want to do something fancy, tricky. Yeah, I'm not sure this is the way for you. I'm not sure you should attempt it, frankly. That's another conversation. But if you want to stay what we believe, generally to be in between the bright lights of what's acceptable, then this is very much worth pursuing and looking into. So there's that on the instrument versus others. I think Brett was one of your questions. And then in terms of how to address the next part. I think probably one of the toughest things to get through is, and we see this in our work with large family offices, we see it in our work with individual investors, not so much with institutions. They tend to have a different approach to things, but is getting comfortable that the way you made the money, real estate, private equity, started a business,
Cryptocurrency.
whatever. Yeah,
Yes.
exactly. Yeah, isn't necessarily the best way to keep the money and grow the money, right? The toughest job we ever have, and this is more with family office work, is getting families that made a lot of money on real estate, understanding that they need to diversify and that there are mechanisms to do it. And one vehicle to help you do that would be to form a deferred sales trust, put it in an appreciated asset, sell it within the trust. Brett knows the mechanics far better than I. And that will allow you, to manage the realization of those gains and that taxes, but also importantly, be a great vehicle for you to convert into other assets. You can still own real estate in a DST. That's very doable. But I think it's getting people to understand that the way you made your money is not the only way to hold and keep your money going forward.
Absolutely. And I want to open it for questions now. I'm going to start with Jake Miller because I know he's a financial advisor, and he actually, I don't know if you guys have met yet, David and Jake, but now I want you guys to meet for sure, right? Because I think this is a part of, well, I like to say, building the dream team, right? To service on folks that are looking for ways to do everything we're talking about here. So Jake, any insights or thoughts on what David just said?
Yeah, absolutely. In fact, along those same lines, David, in fact, we've met once before. We had that client that was looking at selling $100 million development a while back. And so
the name is familiar.
Yep. We briefly were introduced in that mutual client. But in regards to a lot of the clients that we speak to that have or are creating a deferred sales trust, a lot of them are faced with a crossroads. They've made their big money typically in one way. It might be through real estate. It might be through crypto. It might be through shares in a business that they brought up from the ground up to really, really high, and then they sold the shares. Regardless of how they made their money, they're faced with a crossroads of decisions in the sense of what should they do with the proceeds now? And in light of today's discussion of the markets and everything that's going on in society that might affect the rise and fall of the price of whatever, maybe in a very direct fashion, somebody who doesn't have any immediate plans, but they want to meet that 8% promissory note obligation. Can you kind of give us an idea of what is expected to steadily do well over the next short period of time? And again, this is very, very short term. This is more like corporate asset management. We're not shooting for the moon, but how would you layer a portfolio so that individuals can just meet their minimum obligations within a deferred sales trust for that promissory note?
So most promissory notes have required rates on the order of 5 or 6%, 7%, 8%. This is a kind of common zone. That's a decision that can be made. We've seen them lower, we've seen them higher. Kind of the mark. We'll call it 6%, just as a number for discussion. It used to be, well, and one of the advantages, of course, these are normally 10-year notes, a 10-year life for the structure. And one nice part about it is 10 years is a good long runway. In our world, as Jake would know and others I expect might know as well, time is the most valuable thing that investors have. It helps us not be speculators. It helps us be patient. It helps us if we enter at maybe not a great time into a particular asset, stocks, bonds, whatever. It gives us time to recover. A lot of really, really good things happen as the time horizon lengthens. And so this idea in a DST that we can let the money work for a while is very powerful. However, to Jake's specific question, what about the first step? What about the first 1 or 2 or 3 years, if I understood it properly? And that's difficult. In the olden times, you could have a portfolio that was heavier in fixed income instruments, high quality corporate bonds, mortgage-backed securities, a whole range of different debt-based instruments. And And you could be up in that 4, 5, and even 6% range. 6 is maybe a little aggressive unless you had some high yield and other things, and they're also very reasonable. Maybe you could mix in a bit of equity exposure, and you could get there. In this environment, we can't do that, and we can't do that right now. In particular, rising rates cause debt prices, bond prices to go down. So what we need to do right now is think about a two-step strategy. One that caters to the next 6, 12, 18 months until we get through the rising rate environment, Fed and Treasury taking money back out of the economy, as we discussed before, and get through this whole kind of let the market kind of digest this price pressure or this inflation. And that means I think that you have to have maybe a little bumpier ride in the beginning. It's probably larger cap, more blue chip, nicely diversified. We love dividend paying stocks, right? So probably maybe even the opposite of what you would normally think, right? Normally, I would say let's have 60, 70% in debt instruments and 30 or maybe 40%, not even that much in these kinds of stocks. That would be the best long-term blend. But until we get through the current interest rate environment, we have to think about being a little more creative, probably flip that allocation. And I would think about some other non-traditional forms of yieldy assets, REITs and other such things can also be very, very effective. So diversified, but clearly steering away from the core of the bond market, at least in the next 6 and 12 months.
Very good. We've had a variety of discussions with clients that are okay, based on some of the same concepts that you've shared with us, okay with more of a preferred stock with high dividends to help produce some of that same yield and accomplish some of those same goals, but higher blue chip type preferred stock that isn't nearly as volatile, etc. I like what you said about those REITs or perhaps some of the alternative investments. Can you maybe elaborate a little bit more on that? And I'm sorry I'm taking up so much time, but help us understand how the alternatives now are fitting more into this space than before, perhaps.
Sure. And there's been I think it's fair to say it's a bit of a revolution in terms of the liquid alternatives market. So alternatives used to be for qualified or accredited investors, people with multiple millions of net worth and lots of liquid assets and deemed to be sophisticated and have substantial means. And that's still the case. You can get privately placed, lesser liquid things like hedge funds and private credit funds and multi-asset real estate limited partnerships, and all these things are still out there. And they could make sense depending on the individual and a whole lot of other factors. What we have in the last roughly 5 years or so is those types of underlying assets being recast, being repackaged into mutual fund and exchange traded fund wrappers. These are registered investment companies that allows them to be listed and traded either on an exchange or somewhat different case in the form of a mutual fund, which I'm sure most people are familiar with. There are interval funds, which allow only quarterly investment to come in and out. And there's some other, different structures, but there's also daily traded liquid alternatives instruments that cover the spectrum from private debt, private credit, private equity, esoteric hedge fund like long short volatility based trading. There's quite an array actually. And so we have a strategy which we call extended yield. I'm not pitching that strategy here today, but it's a good vehicle for this conversation where we say, wait a minute, if I can't get the kind of yield that I would normally get from a traditional debt instrument, and now, and in fact, quite the contrary, I might even have price declines as rates go up, at least for this near-term period. Can I expand the definition of yield and disconnect it from this idea of fixed income and debt? And can we talk about things like real estate investment trusts, structured private credit, ETFs or mutual funds or other things where the underlying asset isn't necessarily a bond. It was never a bond. It was never a loan, right? It's a fundamentally different type of underlying asset. And in that category, we would put convertible bonds, preferred stocks, as Jake mentioned. We would put real estate of various asset types. We would put structured credits, collateralized loan obligations. The list goes on and on and on. I won't cover them all here, but these can get you up into the 4 and 5 and 6% yield zone, with giving you a degree of insulation from just good old-fashioned interest rate increases. So those are the sorts of instruments we would mix in this whole idea of liquid alternatives. Which can make a lot of sense. Hopefully that's helpful.
Appreciate that explanation. We actually have Kevin Mitchell here with us today, who's looking to raise a fund specifically for solving an issue for arbitrators in the short-term rental space. And so right now there's a huge demand for people who are subleasing and wanting to short-term rental a space, and there's very low supply for that type of thing. And so it's interesting enough that they have that. I don't know, Kevin, if you want to just say hello real fast, maybe ask a question of Dave.
I think you're on mute.
Oh, you got to turn your volume on.
And then Pierce will be up next on the other question, Pierce.
All right, Kevin. So
you're still muted there, or you can't hear you. Pierce, why don't you ask your question and we'll get Kevin squared away. Go ahead, Pierce.
Hey, David, pleasure to meet you. I'm down in SoCal here as well, so we'll have to definitely connect sometime. Yeah, just I come across a lot of people who have just a degree of skepticism with the Deferred Sales Trust, and I just wanted to ask, what was it that solidified the DST as a legitimate option for you through your 2 years of due diligence that you did? What was that thing that just sold it?
I think it was getting on a plane and flying to Lake of the Ozarks, Missouri, and sitting with Todd Campbell and others in his group there, spending some time. There was some fun on the lake as well. It didn't hurt. And just getting to know them as people really helped. We read things in bios, and in the world of today, it's unfortunately too easy for folks to put on a facade. And you have to take extra steps to kind of get through that, get around that. I'm old school, sit across the table from someone, look in their eyes, you get a different feeling for things. We cannot say that we are experts on the legal, tax, and other elements of the structure of the DST. We're lowly economists and money managers. But we did our diligence. We went out, we met them, we looked at various reviews and findings and things that happen in the course of business. NDAs would be required for that. You can see that tax authorities and other authorities have looked at these structures and written, opinions probably isn't the right word, but kind of like no action letters, like, yeah, okay, fine. Don't take that from me. You got to do your own research. But looking at that sort of information was helpful to us as well. So that was Brett's point before. We maybe had a little inside track, as we were preparing to associate ourselves with the group, with the estate planning team and the DST as an instrument, DST Wealth Management, and all the trustees. Our reputation is all we have at the end of the day. And as my, English grandfather used to say, you'll only, don't risk your reputation because you'll only lose it once, meaning you'll never get it back to lose it again. So that's what I would say for us made the difference. And visiting the team out in Indian Wells as well, we're a little bit spoiled in that, or fortunate in that we Bob Binkley, the founder of estate planning team, is just a few miles down the road here in a place called Dana Point. We're in Newport Beach, easy drive, nice drive. And so we had the luxury of proximity also to Indian Wells, where the staff is very impressive as well. It's the people at the end of the day. make it work.
Yeah, I was going to say it sounds really, it's a lot of just about the people in the team is what really sorts.
Yeah.
Well, and if you can't understand it, sorry, real quick. If you can't understand, another old adage, right? I'm not that old. I'm not sure why I'm on the old adages today. Right is, if you can't understand it, then you should not invest in it, and you sure as heck should not recommend it. Because if you can't understand it, yeah, there's probably a pretty good reason. And we see a lot of things. We talk to do a lot of investment due diligence. And the number of times we'll look at it and say, I don't understand it. I don't even know how they make money. And we're not interested then, because we're smart enough, we think, to figure it out. If you can't figure it out, I would run away. But this you can figure out. You just have to put in the time and effort and get good advice.
Exactly. Another thing we say too is people aren't often exiting their highly appreciated asset every other week, right? Like an IRA or 401k, something that's pretty common, or even 1031 exchanges. There's 5,000 QI companies out there, and there's all kinds of brokers that are every single day educating, on the 1031 exchange. And that's my background doing 1031 exchanges. I remember that. And I remember Robert coming in and speaking on the Deferred Sales Trust for the first time and saying, wow, like there's something different here. But there was one law firm, right? And kind of at that point, kind of like one financial advisor, if you will, talking about it. And so it took us time to understand it and then actually use it, and then to actually, recommend it. And then now we coach and teach on how to do this every day. And so at the end of the day, it's education, but then it's not just the education, it's also the execution of the business plan, because this is a business trust coupled with an installment sale. And most people know installment sale, 453, seller carryback, but they don't necessarily know like business trust, right? And it's connecting those two. And then it's the team behind it. My role would be the third party unrelated trustee. Jake Miller is the financial advisor, and then David Young can also support other financial advisors to help to be a part of the management team for the funds. And so it's that team to execute, and then the tax attorneys to do the legal part. And I always like to say, Dave and Jake, what you guys think? We have these little shields, right? It's like the Spartan army or Spartan soldiers back in the Roman times, right? And they've got the little spear and they've got the shield. And each of us has our own little expertise, but it's not one of us by ourselves. It's all of us collectively lining up and then helping the client to execute on this. Any thoughts on that, Jake?
No, I mean, here we are essentially just helping the clients navigate these tumultuous waters of taxation, of how do I transact my transaction in an efficient way, and how do I maintain a steady and consistent rate of return that aligns with my objective. And again, as David has mentioned, we bring in a lot of specialists to help out with the tax side, to help out with the investment side, to help out with everything in the middle and in between, and from the contracts to their business. And in a way, we're consultants. We sit down with the client, we hear their objective, and we try to help them reach that objective in an efficient way.
Yeah, very well said. David, any thoughts on any of that?
No, I think it's spot on. I am curious. You're the MC. I don't want to take your job. If we can hear from Kevin, you had some audio.
Yeah, Kevin, are you ready back? Are you ready?
All right, are we good?
There we
go.
All right. I tried to get fancy and use the AirPods, and there you go. So it wouldn't be a Zoom meeting without technical difficulties. But Brett, Jake, David, I appreciate the time here. And Jake already did a great job of sort of doing a softball pitch for me. But essentially, my group and I were spinning up a single purpose vehicle where we are doing something unique and innovative in the short-term rental space. So if anybody knows anything about arbitrage, obviously, it's a model that has been around for a little while. And the biggest hurdle is, people getting access to assets. So our fund is essentially being the asset provider and then locking these arbitrators into a long-term leasing agreement for a premium. So it's essentially a win-win on both sides. So you talk about creativity and diversification and all these things. I think for a lot of people, especially trying to diversify maybe out of crypto or, some of the other things that they're engaged with. This may be something that they haven't considered that yields pretty significant returns.
I would view it as a means or a method of being able to invest in real estate, but in a very innovative way. This isn't your typical build and construct. This is your typical buy and remodel. This is something definitely innovative. But anyway, I don't know what any questions you might have, David or Kevin, for David.
The question I was going to ask, and actually Pierce did a great job of asking it, so I won't repeat that. But for someone that before this call may have not done a lot of research on DSTs, I mean, beyond reaching out and bugging you, David, where's a good place to start in terms of research?
Yeah, I might even turn that back over to Brett. I think that Brett's website has a lot of really good information on it. I think I don't want to volunteer him, but I expect he and his staff will be willing to take a call. The estate planning team has, I think, a good website as well. I think they'd be willing to take a exploratory call. Brett, how do you?
And we're all part of the estate planning team, right? That's like kind of the big mothership that helps to organize it. And then there's individual trustees. That's our role, capital gains tax solutions. By the way, we do have a book coming out. And if you believe it, I'm in the book, which is kind of cool. But even cooler is Jake Muller's in the book. And even cooler is David Young's in the book. Maybe even cooler than all of that is Kevin Harrington from Shark Tank's in the book. So you can also check out the book. It's not released quite soon. Also, Robert's in the book as well. Robert Binkley's in the book. So you've got a lot of people that are a part of this. And so that would be the best places. And then you go to our YouTube channel, Kevin. It's Capital Gains Tax Solutions YouTube channel. Has a ton of free content on there. We got our ebook, capitalgainstaxsolutions.com would be the places, okay?
I would also just add to keep coming to these weekly masterminds. There's a ton of great information on these things that we do, case studies like we did last week and whatnot. So this is definitely a great place to learn.
And by the way, Pierce is a part of the Capital Gains Tax Solutions as well. He's a Newport Beach luxury realtor down there, and a good friend of mine, and he's also a part of the team. So you've got a ton of people to connect with, Kevin. We're here for you, my man.
So very, very along the same lines as what Kevin asked for. We have a fellow here who has an amazing last name, and I've actually never met him before in person, but Justin Meller. He has a business that focuses on helping people from a consulting, accounting, tax standpoint in regards to the employee retention credit, which a lot of those big business owners are also at some point currently or in the future in need of services for the Deferred Sales Trust. Brett, can we help Justin, maybe let him say hello and help him know and understand how to work with us for the Deferred Sales Trust for some of his clients?
Yeah, Justin, why don't you say hello, where you're from and what you do? If you can hear us.
You got to unmute yourself there.
Of course. Yes, name is Justin Meller from Utah, Highland, Utah is where I live currently, originally from Idaho. I own a small CPA firm, and over the last year or so, our firm has been specializing in something called employee retention credits, which I'm sure a lot of business owners have already heard about, but those that haven't or haven't taken advantage of them, it's definitely worth taking a look at.
Fantastic. And so how just in a quick thing, like who would use it? What does it look like? And is it spelled MELLOR too? Yeah.
It is. Yeah.
Okay.
We have a website that's pretty informative. It's called employeeretentioncredits.com. So that's employeeretentioncredits.com. Educates, gives everybody a little bit more familiar with it. If they want to determine if they self-qualify or if they want to call us first, and we can walk them through that process. But
cool.
Employee retention credits in a nutshell was part of the COVID CARES Act. It was passed approximately 2 years ago, when COVID hit. Originally, businesses that received a PPP loan could not take advantage of the employee retention credit, but they subsequently changed that and amended that back in December 27th, 2020 to allow that to happen. So companies that received 1 or 2 PPP loans can still take advantage of the ERC. In fact, they're more likely to qualify for it. And it's up to $5,000 per employee in 2020 and up to $21,000 per employee in 2021. So if a company qualified for the maximum available, could be up to $26,000 per employee, which is very significant. Employees, or whether you've got 300 or 400, it ends up being a very material refund for those businesses.
That's awesome. Yeah, I definitely see us being able to connect offline and then figuring out a way to strategically align. Because at the end of the day, again, you come into the shield in your spear, Justin, right? We're not experts in that. So if there's a way for us to connect, maybe Jake can set that up. Thanks for sharing, Justin.
Thank you.
Cool. Other than that, any last questions for David? We're running out of time. In fact, we're over time. I had to kind of twist his arm and say 30 minutes, but I didn't want to rush him, so I could say, but I know he's probably got to jump here soon. So is there any last questions for David before we let him go?
I think it was a great meeting. I have to just say, this was like one of the best since I've been on here for like the past, 6-7 weeks. They're always good. They're always great, but today was really great. Thanks, David, for coming on today.
Sure thing. Hold your thanks until after I have to torture you with my disclosure. We
oh yes, David, please read that now. That's right. Read the disclosure, everybody.
Sorry, we dove right in and we talked a little more about investing in specifics, which I'm always happy to do. But I know what's going to happen when my chief compliance officer views this, which he will, and then I will get that knock on my door, and here he comes now. No, I'm reading it. So sorry about this. It's a highly
no problem, David. Just read it. It's good. It's good.
That means it's good for you. So Anfield Capital Management LLC is a registered investment advisor with the SEC. Registration as an investment advisor does not imply a certain level of skill or training, and no inference to the contrary should be made. This interview is for informational purposes only and does not constitute investment advice, an offer to sell, or a solicitation of an offer to buy any securities. While many of the thoughts expressed in this podcast are stated in a factual manner, the discussion reflects only Anfield Capital's beliefs about the financial markets in which it invests portfolio assets at this time and may change at any time. The descriptions I make are in summary form, are incomplete, and do not include all the information necessary to evaluate any investment. Prospective investors are referred to our Form ADV-2A for a more detailed discussion of risk factors, which can be found A, on the SEC's Investment Advisory Public Disclosure website, advisorinfo.sec.gov, or provided upon request.
Perfect, David. I want to thank you, David,
with you,
for being here. It's such a pleasure, such an honor, and thank you so much for all that you're doing for all of your clients. I want to encourage you to keep using the gifts of your amazing mind, insight, thoughtfulness to make a difference to people, to help them create and preserve more wealth. And by the way, if anyone wants to find David, you can go to AnfieldCapital.com. That's AnfieldCapital.com. David Young, thanks for being here. By the way, Jake, if anyone wants to find you, where can they find you, Jake?
Absolutely. So we have a website. It's a brand new website, strategictaxsolutions.com. I think, as you can hear the swimming pool next to me, hopefully we'll post some pictures of the beach or something as well. You can also reach out at 1-800-773-1848, 1-800-773-1848, or Jake at Strategic Tax Solutions.
Amazing. Pierce, are you still there? I'll let you do a little plug too, my man. Are you still there?
Absolutely still here. Yeah, this was phenomenal. David, thanks so much for your insight, for sure. You guys can find me at kingdomluxuryrealty.com or on our Facebook page, Kingdom Luxury Realty Facebook page.
And you can also just search Capital Gains Tax Solutions on YouTube and see Pierce that he's taken over the podcast. So, in the world of growing, you got to delegate, and Pierce is doing a phenomenal job taking over most of the podcast, not all of it, but a lot of the work there. So thank you, Pierce, for doing that and for leading in that way. And if anyone wants to connect with me, you can go to capitalgainstaxsolutions.com. And I just want to thank you for attending again. Invite someone next week. And remember that you're only one deferred sales trust away, and that could be one deferred sales trust away from exiting your highly appreciated crypto business, real estate, diversifying, getting cash flow, paying some taxes. You receive that cash flow, but realizing that we all want time and energy, right? And this can give you that time and energy that you want. We want to create some opportunities for you to look at all of this in a thoughtful way, all no cost, no obligation. Just go to capitalgainstaxsolutions.com. Appreciate everybody watching. Please rate, review, subscribe to the channel, and we will talk to you next week. Bye, everybody.
Thanks guys.
Have a great weekend. Bye-bye.